Hello, my name is Isaac Thomas, and today my colleague and I, Charlie Canold, are here from ArchPoint Partners to discuss Altice USA's restructuring plan.
So we'll get started with the executive summary. We have six main things that we are going to take a look at. We're going to start off with the company overview. This is going to be just getting a general understanding of what Altice USA does. Then we'll move into the situation overview. We're going to take a look at exactly what kind of situational tasks they're facing. Then we're going to move into the capital structure, take a little bit more of a deep dive into what their capital structure looks like, the kind of debt wall that they're facing, and other issues that they have there. Then we're going to move into the business plan. We are proposing a three-pronged solution to achieve adjusted normalized EBITDA, and we're going to kind of take a deep dive into that. We're going to look at valuation summary after that. We've performed a variety of different valuation methodologies, so we're going to kind of go into those and look at what we have our implied enterprise value as. And then finally, we're going to wrap it up with strategic alternatives, looking at ways that Altice can employ strategic alternatives properly and safely. So we're going to begin here with the company overview, looking at Altice USA's background. So Altice prioritizes in three specific services. They have cable TV services, internet services, as well as advertising and partnerships. So for their TV services, they promote to both residential and business customers, and they promote fiber optics and cable services. For their internet, they have specific internet services as well for both residential and business partners. They have different data limits that they offer, as well as different speeds, depending on customer needs. And then finally, for advertising and partnerships, they promote B2B advertising. So they leverage a lot of the data that they've collected on customers to try and help advertisers grow their revenues and increase click-through rates. So then looking next at who gets Altice, we'll take a look at the geographic breakdown. So they're primarily located in three areas, the South or Central South, the Northeast, primarily the tri-state area, and the West Coast, including California. So their main focus has been recently on the tri-state area, primarily Pennsylvania, as well as parts of California, as they're trying to adopt their AI hyperscalers and really improve their AI-grade fiber optic infrastructure through one of their subsidiaries of Lightpath. So this has been a really big thing that they've been pushing in the last quarter or two, and something that we're kind of continuing to take a look at. Now, moving specifically into how they are promoting their products and what kind of profits they're looking at. They have a five-tier package that they're trying to consolidate into a three-tier, but they're looking specifically at promoting this lower tier that they have offering. Their competitors are trying to alternate, and they're trying to stay true to helping these lower tier people, lower tier services. So this includes the basic TV as well as the Fast Pass. And this is kind of moving in line with the larger market signals. So cord cutting has become a very common issue that Altice, as well as its competitors, are facing. And this is shown here through the graph. We can see that there's 45% of all telecommunication revenues are coming from streaming, and only 22% are coming from cable now. So there's been this big shift that Altice is having to try and overcome. And then we can kind of take a look at what Dennis Matthew, their CEO, his kind of overarching long-term strategy looks like. So he's looking at three specific things for their future. The first is customer excellence and consumer excellence. So Altice is trying to leverage a lot of its AI and its agentic AI experiences to try and promote this really big value add for its customers. So it's using this through specific ways, including their access network automation, which are ways that they can kind of continue to move AI tools into their infrastructure and help their customers. Secondly, as I was just discussing, they're looking at more income sensitive targeting. They've seen a 10% lift in sales in income constrained areas for the second quarter of 2025, and this introduction of the three-tiered video offering that I was previously mentioning. So they're trying to go full steam ahead on this specific grouping. And then finally, they're trying to look at ways to lower operating expenditures. So they're leveraging a lot of these data analytics that they're starting to utilize in order to find ways to focus more of their supplier relations, as well as decrease some of their costs. So they just recently cut 5% of their workforce in an effort to lower this operating expenditure. Now we can take a look at some more of its specific challenges and its situation overview. So we're going to take a look at four specific sections, which begins with its capital structure. Then we're going to look into some liquidity issues that it faces, some financial issues, and then finally some overarching business issues. So in terms of its capital structure, its leverage that it's currently facing makes refinancing extremely expensive and difficult. So it currently has a net debt to EBITDA ratio of 7.8 times, and it has a significant debt wall that it's going to be surfacing in 2027 to 2028. So this is a huge issue that they've been facing, but they're starting to try and take a look at it and see ways that they could mitigate this risk. So recently, management just pointed towards a $1 billion asset-based lending loan that they acquired from Goldman Sachs. It was the first of its kind in a proprietary loan. So they're trying to see that becomes a precedent for ways that they can pay off their debt wall come 2027. Next, they're looking at liquidity issues. So their bond prices have been fluctuating a lot, and it's signaling large market distress and fear towards Altice's market offerings. So their CSC holdings unsecured $2.25 billion 2030 bonds, they've dropped to 42 cents on the dollar. This signals a really strong lack of confidence. And other bonds, including their February 2027 bonds, have traded as low as 74 cents. And more recently, their credit rating decreased to a triple C on the Moody and Standard and Poor's rating. So there's clearly this large liquidity issue that's facing the company. And then taking a look more into their financial issues, they've seen large-scale EBITDA erosion as well as cash burn, which has reduced their ability to service this huge debt wall that they're facing. So their adjusted EBITDA continues to fall. They've had high churn rates over the last 2 quarters. They lost 58,000 video subscribers in both quarter 2 and quarter 3. And in quarter 3 specifically, they saw net losses of $1.3 billion. This was attributable to two main things, which the first was $460 million in interest expense, and the second was $1.6 billion in both a one-time impairment fee as well as restructuring expenses that they're facing. So this one-time impairment fee was a goodwill write-off, so it's not something that's going to be sustained long-term, but these restructuring expenses could be something that begins to sort of take shape and cause some issues for them. And then finally, looking at business issues, they've had subscriber losses and annual revenues per user decline, which is weakening some of their future. So management pointed towards this idea that consumers are starting to quote unquote cut the cord. So it's an issue that's been facing the entire market, but they're saying that it's leading towards 85% of their overall revenue decline in quarter 2. And it continued in quarter 3, where they saw 5.4% decrease in their year-over-year revenue. And this is something that's also kind of plaguing their competitors as well, and their competitors are looking for creative solutions, and Altice is trying to take a different approach. But their competitors are trying to find ways that they can kind of push this customer growth through attractive low margin offerings, and Altice is saying that this is an unsustainable way to approach it, so they're looking, as we had previously mentioned, at some of these more low income tier offerings. So then moving into their capital structure specifically, their capital structure has debt maturities that we had just mentioned that are trying to kind of bubble up by 2027, and they're mainly attributable to its subsidiary CSC Holdings. And as we can see on the capitalization table on the left, we have interest rates that are fluctuating between 3 and 11%. So this is a large issue, and it's leading to really high interest expenses over the year. And this is an issue that isn't really mitigatable right now. 73% of their total debt stack is completely fixed, which means that it's really hard for them to refinance right now. They don't have that much of a capability to refinance, which could be problematic in their future. Finally, they face a weighted average life of debt at 3.4 years, and this is relatively short compared to their competitors. Their competitors like Comcast are seeing upwards of almost 11 years in terms of their weighted average life of debt. So this could be an issue that Altice faces in its future, where they're struggling to kind of prolong its debt periods, and it has revolving debt maturities that they are unable to continually pay for. So now how do we kind of find a solution? What's our business plan? So we break this down into 3 categories, which begins with revenue creation, then we'll move into some cost mitigated factors, and then a business consolidation factor at the end. So first, for its revenue creation, we see two potential opportunities. The first is a tier upselling, and the second is a mobile attached to broadband. So first, for their tier upselling, we see the opportunity for them to use a lot of these data analytics that we've been discussing to try and advance their customer segmentation and identify people that aren't being utilized as much as they can. So there might be certain customers that are on a 500 megabyte plan that could be on a gigabyte plan. So using this kind of data analytics and software that we have, we can look at ways to kind of bump them up, and we see this as increasing EBITDA by $70 million by 2027. Then secondly, for mobile attached to broadband, we see this as another opportunity for Altice to pursue. So pushing an automatic mobile with a broadband subscription or a plan can increase their current attach rates. They're seeing current attach rates of around 16%. This means that roughly 16% of their broadband users are also on their mobile plans. competitors are a lot closer to 30%. So we see that there's a strong, strong capability for them to push to this 30% by 2027, and this will increase EBITDA margins by over $80 million by 2027. Next, moving into their cost mitigation strategies, we see the ability for them to recut programmer contracts. So currently, they've been talking about the issues that they faced with their programmers. They've had blackout issues, and they've had this inability to kind of renegotiate terms. But they have a lot of these contracts that are coming due in the next 2 to 5 years. So we see the ability for them to cut costs by 1 to 2% within the next 3 years. And this is again utilizing these predictive analytics, seeing what customers really want and seeing where they can kind of cut costs in this ability. So with this, they could cut costs by over $70 million by 2027, which would be a huge benefit and a huge gain for Altice. Then finally, in business consolidation, we see this as a two-tiered solution again. So there's the optimum media integration as well as other operating expenses minimizations. So currently, the Optimum Media has gone through a number of different changes. It was initially A4 Media, and before that, it was actually a group of different media companies that conglomerated under Altice. And now they're kind of conglomerated, but they're still struggling to have more widespread expenditures. So we see the opportunity to kind of consolidate this alongside with their other operating expenses. Altice has also pointed this out in their recent earnings calls, saying that they're hoping to decrease their operating expenditures by 6% by 2026. We see this as an ability for us to get really aggressive and really push this operating expenditure reduction. And we could see EBITDA increases of over $150 million in the next 3 years, given this strategy.
Thanks, Charlie. And now we're going to go ahead and take a look at our valuation summary and kind of how we came to value Altice in its current state. So here we have a valuation overview slide, which is essentially showing our valuation ranges across the different valuation methodologies. First, we have comparable companies analysis, followed by precedent transactions, discounted cash flows, and liquidation analysis. You notice that our implied median enterprise value is $22.796 billion, which is derived from those four valuation methodologies. The first comparables ranging from around $15 or $16 billion to around $26 billion with a median of $20.9 billion. The second precedents ranging from around 10 to 32 billion with a median of $23.24 billion. Discounted cash flows with a smaller spread of around 20 to $25 billion and a median of $22.182 billion. And liquidation valuation, which, as you can see to the side note, was only a single point because when you look into the evaluation, which we'll see later, you notice that all secured creditors absorb this liquidation proceeds. And since there's no residual value for equity holders, the resulting valuation that's implied for each base, bull, and bear case scenarios are all the same. It's simply the value of their debt outstanding. So now we'll go ahead and jump into that first valuation method, public comparables. You can see at the top that our implied enterprise value is $20.916 billion, which is derived by looking at that EV to EBITDA column all the way to the right. But going back to the beginning, we first started by deriving our comparable companies by looking at things like geography, industry, and size. First, for geography, we wanted companies that were based in the United States. Since Altice USA is based here in the United States, we wanted companies that were subject to similar regulatory regimes, tax codes, and similar things like this to help align their business models with Altice's. Second, we looked at industry. You notice that all three of these companies are in the telecommunications and fiber optics game. They have very similar growth drivers and as a result make good fits. And finally, as you can see in the debt to total capital column, we tried to choose companies that had similar degrees of leverage in order to represent similar business models, similar challenges, and similar interest expenses. Going back to the multiples, you'll see that we have three multiples displayed. I'll jump forward to the EV to EBITDA multiple because that's what we focused on for our valuation. You notice that EchoStar in particular has a very high EV to EBITDA of around 28.32 times. This was due to the fact that their EBITDA is currently depressed due to, as Charlie alluded to earlier, this idea of cord cutting. And since one of their main services, as you can see in the company overview, is pay TV, they've seen annualized decreasing in their top line revenue figure, which has caused that kind of multiple expansion and thus for them to have an extremely high multiple. But when excluding that, we see that the median is 6.3, and when we multiply that by Altice's EBITDA, we resulted in that $20.916 billion valuation. So next, going to precedent transactions. This is another form of relative valuation that we took by looking at comparable M&A transactions over the past 3 years and trying to build back towards an implied enterprise value by looking at EV to EBITDA multiples implied from the transactions themselves. You notice that we identified four key transactions based off of things like total enterprise value, which we aimed for a consideration over $1 billion, as well as a similar industry, similar to the criteria used in the comparable companies analysis. Kind of at a high level, we had a few main takeaways. One was that we found it a bit challenging to find specific precedent transactions due to the limited amount of information out there, but we felt that these were good comparable transactions that we could use in evaluating Altice USA. Second, we used a 3-year look back period, again, due to similar issues in finding them within a more confined 1 to 2 year period. And finally, if you focus in on that EV to implied LTM EBITDA column, we applied the median EBITDA of 7.0 times EBITDA times Altice's EBITDA to get to our implied precedent transactions of $23.24 billion, which, if you remember back from that previous slide, was that targeted point that we saw on the valuation summary slide. And now we'll go forward to the first intrinsic valuation method that we were discussing, the discounted cash flows model. So we have a lot going on here. I'll just try to keep it to a high level overview and also point out that we have more supplementary information in the appendix, including a very detailed WACC table, as well as some assumptions for other things like our working capital changes. So starting at the top, we projected sales using both historical estimates that were sourced from Altice's 10K, as well as projections from FactSet's consensus estimates. We found that sales were to grow at approximately a negative 3.2 CAGR over the projection period from 2026 to 2030, which is in line with estimates from analysts who predict their revenue to decrease over time, facing those same business challenges that Charlie talked about earlier. Moving down, we use a similar approach of both using historicals and projected figures to get to Altice's EBIT. To that, we applied 1 minus the tax rate to get to their NOPAT, or earnings before interest and after tax. From there, we added back non-cash expenses, namely depreciation and amortization, subtracted net increases in working capital, as well as capital expenditures to get to our projected free cash flows for each period. We then, using the mid-year convention, applied our WACC, which we determined to be 8.8%, again, using that WACC table that's in the appendix, calculated our discount factors by raising each denominator to the power of that discount period, 0.5, 1.5, 2.5, all the way to 4.5, added those together to get the present value of our free cash flows. Then to calculate our terminal value, if you move slightly to the right, you can see that we started with our terminal year EBITDA and used an implied equity multiple derived from our comparable companies to get to a terminal value of around $24 billion. To that, we applied our discount factor to discount that terminal value, because again, it's at the end of our projected period back to the present value to get to around $15.8 billion. We added that figure to the total of the present value of free cash flows to arrive at our final enterprise value implied by the discount cash flows model of around $22.182 billion. To test this, at the bottom, you can see that we backed that $22.182 billion value into our implied perpetuity growth rate, which we found to be around 2.2%. We were very happy to see this, as this is in line with both long-term GDP growth rates as well as inflation rates, whereas we wouldn't want it to be greater than either, as we would either imply that our value would be inflated over time by inflation if it was lower than inflation, which is around 3-ish% when adjusted for growth over time, as well as the GDP, because if it was too high, it would imply that the company would grow larger than the entire US economy, which doesn't make any sense. We're happy to see that. And then finally, we have our implied EV to EBITDA multiple, kind of backing back into that again. And then our final intrinsic valuation method is a liquidation valuation, which here we're taking a look at our balance sheet, specifically our assets and liabilities, and saying, if we can take our assets and say we go to auction and sell them, how much proceeds do we get? And then how can we use those to settle the claims on those assets, namely the debt and the other claims, such as trade financing and things of that nature. So on the right, we have our rationale, but kind of focusing back on the left, we can see that the total gross asset proceeds are displayed in 3 different cases: our bull base and bull case, or bear base and bull cases. The derivations from those can be found in the appendix, but essentially what we did is we looked through each asset line item, applied an implied recovery rate, and then added them all together to get to that total gross asset proceeds, which is that top line. From there, we subtracted our estimated liquidation costs, which are things like administrative fees and legal fees, which are subtracted out before we can distribute to our capital structure to give us our net liquidation value of 51.82, 61.85, and 71.88 million dollars across the three cases. Kind of skipping through the rest, we started with less. We started by subtracting out our statutory priority claims, which include kind of short-term obligations for things like accrued employee expenses, which by law must be paid out before any other distributions are made, as well as things like interest payable and deferred revenue to kind of assume priority, given the fact that they're in the interest payable case due to the United States government and thus are higher priority. And for the deferred revenue case, under the assumption that we want to create value post restructuring, it's sort of an immediate short-term obligation that we felt would be appropriate to be paid out early. This left us with our funds remaining for secured paydowns. And since we had a total combination of $9.749 billion, and as you can see, a much lesser amount across each of the funds remaining for secured, we ended up having a deficiency claim. And as a result, there was a leftover balance, and all claims below that were out of the money. At the end, we have an indicated equity value that was completely wiped out since there's no pay down to equity holders. And so simply our equity value or our enterprise value was zero equity value plus the balance of our net debt, which in all three cases was the same $26.142 billion.
Okay, awesome. Thank you so much, Isaac. So now we're going to move into a waterfall analysis. And this looks somewhat similar to what we just went through with the liquidation analysis, except this time we're looking at the total enterprise value and comparing our ability to pay off our debts using our enterprise value. So going through this, we can see on the graph on the left with the waterfall chart that we're not going to be able to pay off all of our debts and that we're actually going to go into the negatives, trying to pay off our debts with our enterprise value. And then moving into the Excel model on the right, we can see a very similar thing. So the specific point in which we begin to be unable to pay our debts is through our class 4. This is our senior unsecured loans. So we can see in our percent recovery that we alternate between the base case, the bear case, and the bull case between 79, 67, and 90%. So we almost are able to pay off our unsecured loans through the bull case, but in all cases, we're still unable to pay back our equity shareholders. So without restructuring, this basically means that Altice faces debts that exceed the enterprise value by over $4 billion. So this is attributable to the base case, but this essentially is saying that Altice needs to go through a restructuring strategy in order to be able to pay back its debtors, or else they will force bankruptcy. So let's talk about these strategic alternatives. What can Altice specifically employ currently that will help them get to where they need to be? So we see four potential options that kind of move through the process of least invasive to most invasive. So starting with our bridge loans, this is the receivable-backed lending strategy that we had recently discussed before about Goldman Sachs. So Goldman Sachs had a proprietary deal that they struck with Altice USA, in which we received a $1 billion receivable-backed loan. So using this as precedent for going into their 2027 maturities, we see the ability to obtain the cash from this and potentially pay off our debts that way. Now, next is potential open market repurchasing. So after obtaining these bridge loans, we have the potential to re-enter the bond market and buy back discounted bonds. As we had mentioned, they are discounted as low as 42 cents on the dollar. So the potential to go back into the market and buy back quickly. This is obviously has potential risks associated with it, and we would have to do it in between regulated filings as customers or other bond creditors being aware of this, they could want to buy back the loans and that would increase the prices. Then next, somewhat more invasive could be other liability management exercises or LMEs. So this would be restructuring specific practices. And this would be a variety of different practices that we could utilize. But the three that we want to kind of target specifically would be potentials for up tiering. This would be moving specific tranches of debt higher. There's potentials for basketing collateral. So this would be a potential where we could look at ways that we could move collateral around to borrow against it multiple times, or potentials for a pending debt priority. So this is again kind of having debt be moved around and potentially moving certain debt into lower priorities or other debt into higher priorities based upon loan agreement contracts. And then Isaac will finally touch on the potential debt to equity swaps.
Yeah, and just to kind of close it out, we have our most kind of invasive strategy, but it's one that has been proven over time to be a pretty attractive solution for companies who are really in a tight situation, which is a debt to equity swap. And essentially, what we're doing here is we're negotiating with our creditors to say, look, we have this large debt balance outstanding, and we're probably not going to be able to pay you back. So instead, what if we swap your current debt claim for an equity claim, which would, although it takes away your, say, guaranteed interest payments and maturity payment at maturity, you would instead get access to a better alignment with our company's goals, as well as the potential for greater capital appreciation with that equity stake. From the company perspective, this is a really attractive offering as it allows them to hopefully lower their leverage, thus lowering their interest expense, and hopefully promote growth on a go-forward basis. However, it's worth noting that with this solution, there is a significant amount of shareholder dilution. So it would take some serious convincing and some more deliberation to go through this methodology. Finally, we have our works cited and appendix. Our works cited has a list of all links we use, and our appendix goes to more detail of the assumptions, as well as some of the other kind of inputs we use to derive our final valuations. Thank you very much for your time today. We've greatly enjoyed talking to you about our solutions, and we look forward to discussing the plans going forwards.